it has the following contents. It has the following content. These are contents of partnership deed. Number one, name of the partnership, name of the partnership, name of the partnership, that is number one. Number two, location of the partnership, location of the partnership. Number three, amount of capital to be contributed by each partner, amount of capital to be contributed by each partner. That is number three. Amount of capital to be contributed by each partner. Amount of capital to be contributed by each partner. Number four, a ratio of sharing profit and losses. Ratio of sharing profit and losses. Ratio of sharing profit and losses. Next, drawings to be made by partners. Drawings to be made by partners. Drawings to be made by partners. Number next, interest earned on capital. Interest earned on capital. Number next, interest on drawings. Interest on drawings. Interest on drawings. And then salaries to be paid to partners. Salaries to be paid to partners. And lastly, duties of each partner. Duties of each partner. Duties of each partner. After that, you write the accounts. Accounts maintained by partnership firm. Maintained. Accounts maintained by partnership firm. Account maintained by partnership firm. Number one is appropriation account. Appropriation account. Appropriation account. Number two is current account. And then capital account. Capital account. And lastly, financial statements. Financial statements. So let's look at the appropriation account. Appropriation account. Appropriation account. Appropriation account, you write, this account is prepared. This account is prepared, appropriation account. This account is prepared. This account is prepared after the income statement. After the income statement. After the income statement of the partnership. Of the partnership. Of the partnership. To show the distribution of profit to partners. To show distribution of profit to partners. To show distribution of profit to partners. To show distribution of profit to partners. And it's prepared as follows. So we have profit for the profit. After the profit that you generate, you put there. Then you add interest on drawings. You add interest on drawings. You have partner A, then partner B. So you add there. Then you add interest on debit balance. Add interest on debit balance. Interest on debit balance. We have partner A, you add. Then we have partner B, you add. So you add those two. And then you less interest on capital. Interest on capital. We have partner A, partner B. You less partner's salary. Partner's salary. We have partner A, partner B. So you less here. Then you get the residual profit. Residual profit here. Then you write your share of profit. Share of profit. So you have partner A and the partner B. And then here. So that is how we prepare appropriation account. Excuse me. So that is how we prepare partners. That is appropriation account. Then we have the current account. So it's an account that is used. It is an account that is used current account. Current account is an account that is used to record. It's an account that is used to record distribution of partners, profit stroke gains, partners profit stroke gains, partners profit stroke gains, and drawings. So it's a temporary capital account. It is a temporary capital account. It's a temporary capital account. And then we have, so this is how it is prepared. And then you write it's prepared as follows: current account. This is how the current account is prepared. So we have the current accounts. So this is the current account. So you have partner A, partner B, partner A, partner B. So you start with the balance, go down in case it is there. You can also have balance go down here in case it is there. Whatever it is, it can either on the sides, can either be debit or. So this side we record the gains that the partners get in the partnership. Like for example, interest on capital, interest on capital is recorded on this side. Then we have partner salary, it is recorded on this side. Then we have share of profit, share of profit. Here we have drawings, interest on drawings, interest on drawings, this side, interest on debit balance, interest on debit balance in the current account is here. Then we get the balance carried down this side. So that is how we prepare the then we have fixed capital account or capital account. Fixed capital account or capital account. So this account is used to record. This account is used to record. This account is used to record. This account is used to record the initial capital contributed, the initial capital contributed, the initial capital contributed, additional capital, additional capital, and the capital permanently withdrawn from the partnership, and the capital permanently withdrawn from the partnership. So this, it appears like this. This is so this is a capital account. So we have the balance brought down. This is the initial capital that was contributed by the partners. This is capital introduced, new capital introduced, new capital. Here you write new capital. If there is any new capital, you write here. And then withdrawn capital. Withdrawn capital. Excuse me. So illustration, CPA, May 2016. CPA May 2016, question number, illustration CPA May 2016. CPA May 2016, question number 2. 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 So the question reads, Maria and Bakari are in partnership sharing profit and losses in the ratio of 3:5 for Maria and 2:5 for Bakari. The partnership did provide for interest on capital at the rate of 5% per annum. The partners are entitled to annual salaries of 1,700,000 for Maria and Bakari respectively. The following balances were accepted from the books of the partnership as at 30th April 2016. Additional information number 1, inventory as at 30th April 2016 was valued at 15,600,000. Number 2, depreciation is provided for as follows. Building 2.5% per annum on cost, furniture 10% per annum on reducing balance, and furniture 10% per annum on reducing balance. I think furniture is at 10% per annum on reducing balance, and building 2.5% on cost. Number 3, the following amounts were owing as at 30th April 2016. Salaries and wages, 200,000, electricity, 90,000. 4, allowance for doubtful debts amounting to 200,000 is to be provided. Insurance paid in advance as at 30th April 2016 amounted to 40,000. Number 6, during the year ended 30th April 2016, the partners withdrew goods from stock for personal use as follows. Maria, 150, Bakari, 590,000. So required, A, income statement for the year ended 30th April 2016, 12 marks, and statement of financial position. So we're going to write here M and B. If they have not given you the name, you write the partners. M and B partnership. Partnership. Income statement. For the period ended. Which it ended when? 30th April 20, and then you underline. So here we can have shillings and thousands. Then here you can also have shillings and thousands. So you start with the sales figure. What is the value of sales from the trial balance? You take the sales figure. The sales figure is how much? 87,460. And then you check whether we have return inwards or what we call the sales return. So you go through the entire thing to see whether we have return inwards. I can only see carriage inwards. So we don't have return inwards or sales return. Then here you less cost of sales. You less cost of sales. So you start with the opening inventory. Opening inventory. What is the value for opening inventory? 19,000. And then you add purchases. What is the value for purchases? 62,140. And then you add carriage inwards. Carriage inwards. Remember, we said carriage inward is the transport cost when you buy goods from the supplier's place to where the business is located. So it's part of the purchases. So what is the value? So you add 960 here. And then you less return outwards in case it's there. And another thing that you less, well, if we have drawings of goods, either you're doing any questions and we have drawings of goods that is indicated in the additional information, indicated in the additional, you less it from the purchases. Drawings of goods here. That is not, it is in the additional information. It means it has not been adjusted, so you adjust. How do you adjust? You credit purchases and you debit drawings. So you'll add to the drawings figure. So here we have 150 plus 590. So that one, how much will it give you? 740. So here you less 740. You get what we call goods available for sale. Goods available for sale. Goods available for sale. What is it? Goods available for sale. 81. This is 81,360. Then you less closing stock or closing inventory. Closing inventory is in note number 1. It is 15,600. So you less 15,600. So how do you get 65? 65, 760. Then you get the gross profit. You deduct, you get the gross profit. What will be the gross profit? $21. So this is 21,700. You check if we have any other income, maybe rent, income. Do you have any other income? No, isn't it? Then we list down your expenses here. You less expenses. So you start with those expenses that require adjustments. You go to note number 2. Depreciation is divided as follows: buildings. So here we have depreciation on buildings. It is 2.5%. You write just 2.5%, and then you indicate on the cost of the building. What is the cost of building? 8,500. How much do you get there? So 212 point. So you write there 212.5. Then we have depreciation on furniture. So you write there depreciation furniture. The value is 10% on reducing balance. Reducing balance is how much? The cost is 3,200 minus the provision. You minus the provision. The provision is how much? 750. 750. So you minus 750. So how much do you get there? 200. So you write there 245. From there we go on to note number 3. So they are testing us those adjustments that we know. The adjustments, mostly we already done it. So the following amounts were owing. Owing means due or outstanding. So we have salaries and wages. Salaries and wages. You pick the one that is already paid. Where do you get it? In the trial balance. How much is it? 2,000. So 2,400, and then you add this owing or not yet paid, which is 1. This one's 2,600. Then we also have electricity. Electricity, how much is it? 500. And then we add how much? 90. So this is 590. Excuse me, 590. Then note number 4, allowance for doubtful debts amounting to 200 is to be made. Allowance for doubtful debts amounting to? Allowance means amount that you set aside from your profit to cater for the debtors that are likely not to pay. So you check whether you had already provided in the previous period so that you're either increasing or reducing. So in the previous period, there's none. It is checked in the trial balance. You check it in the trial balance to find out if there is any provision that had been made before. So this is the first time they are making it. So write here provision for bad debts. How much is it? 200. So you write there 200. And then number 5, insurance paid in advance amounted to 40. So we have insurance. So the one that is paid, you get it in the trial balance. The insurance that is paid, you get it in the trial balance. So how much? 300. So 300, isn't it? So they are paid 300, and out of this 300, you're being told 40 is not for the current period, it's advance. So you deduct for how much you get remain? 260. So I think note number 6, we have done it. So we go and pick other expenses in the trial balance that did not require adjustments. Like we start from the capital, current account, inventories, building costs. We have furniture cost, renovation of building. Renovation of building. How much is it? How much? 1,500. 1,500. From there, you go to where sales, purchases, rent and rates. Rent and rates. How much is it? 400. So you have there 400. We have rent and rates. Then we have general. Electricity, have done it, isn't it? Bank balance, that is an asset or that is a liability. When bank balance is on the credit side, it means an overdraft. It's a liability. Accounts payable is a liability. Receivable is an asset. Repairs and maintenance. How much is it? 1320. So you write there 1320. And then we have general expenses. How much is it? 47? 4,700. Insurance, we have done it. Carriage inwards, we have done. Bad debts written off. Bad debts written off. How much is it? 200? So 270. And then we have office expenses. How much is the office expenses? 600. Provision for depreciation, cash. So those are the only expenses. Then we add them. Can we add them? We add those expenses. $12,897.5. So here you get the profit. You get the net profit. You take this one minus that. What do you get? So this one is 8802. In case we have interest on drawings, now you add. We don't have interest on drawings. Okay, so now we start appropriation from this point down. So we don't have interest on, so we less here, we less interest on, we start with interest on capital. So we have who? Maria, it is 5%, 5 over 100 times the capital of Maria, which is 12,000. Then we have Bakari, 5%. Where am I getting 5%? Where am I getting 5%? The first statements, when you read the opening statement there, they will be told the partnership did provide for interest on capital at what percent? 5%. That is where I'm getting. And this one is already in the trial balance, the 12,000. And then you take 5% of the other partner's capital, which is 5,000. So 5% of 12,000 is how much? Huh? 600. So you write here 600, and the other one 200. And so you add this to, what do you get? 850, and then you subtract. Then you less partner's salary. Partner's salary here. So we have Maria and Bakari. So Maria's salary is how much? 1,000. Maria's salary is how much? 1,000. You're saying 3,000 and 6,000. 700, isn't it? So this one is how much? 1,000. You subtract. Then here you get what we call the residual profit. Residual profit, or the profit to be shared. What do you get? Huh? 62, 52.5. Then you write your share of profit. Share of profits. You start with the Maria. So they're sharing profit in the ratio of 3 to 5 times 62, 52.5. So what do you get? And then Bakari, 2 over 5 times 62, 52.5. Napata ngapi? Eh? Sorry? 37, 51 point. And the other one? Huh? 2501. Just like that. So this one will give you 62, 52.5. Then here you come here and prepare the current account. You prepare the current account here. So here you come here and write the current account. So we have M, Maria, and Bakari. So if there are thousands, you can just write there thousands. We have Maria, and so you start with the balance, go down. Where do we get the balance go down? From the trial balance. From the trial balance. The current account for Maria is how much? 3,000. You've seen it? And for Bakari is, you see both of them are on credit side. So you indicate on the credit side. If they're on the debit side, you indicate on the. So this side, we said you record the gains the partners receive from the partnership, the gains they receive. What are the gains? Interest on car. That is the first one. You write your interest on capital. For Maria was how much? 600. And for Bakari, 250. Then there is salary for partner salary. Salary. Maria, 1,000. And the other one? And then here you write here share of profit. This is 37, 51.5. This is 25.001. Then here you write drawings. You less drawings. We have drawings of cash. Drawings of cash was how much? 2,800 for Maria. You seen it? And the other one is 2,000. Then drawings of goods. Droves of good. Maria was 150. The other one was 590. So you add, and then you come here, write your balance, carry it down. You balance off, right this side, and then you subtract. So you balance this one, you add this one, and then you get the balance there. How much are you getting for the first one? 5401 point. And the other one, another one? 15? 1860. The totals, you have them or you don't have them? Eh? 83. This other one? Eh? 4451. So 4451, 83, 51.5. Then you come and write M and B, statement of financial position. You can write in full. As at 30th April 2016. So you write it in full. So you start here with the non-current assets. You can write in full non-current assets. So the non-current assets we have here, we have building. So we have building here. You start with the most valuable one. Building is the most valuable. So which is 8,000. And then you subtract the accumulated depreciation or the depreciation, which is true, minus 202.5. What do you get? And then we have another one is furniture. So we have furniture. The cost of furniture is how much? 3,200. And then you subtract in bracket 750 is the depreciation for previous years, plus now the current one, which is 245. So this is what we call accumulated. What you charged in the previous year plus what you're charging. To accumulate means whatever was there before plus what is there now, isn't it? Then you minus from this. So here we need to capture asset at the net book value. Net book value means the cost minus accumulated depreciation. So what do you get here? 220 point. So these are the only assets we have, isn't it? Then here we write current assets. We start with the inventory. Inventory, we have it. It is 15,600. So you write here 15,600. Then we have accounts receivable. Accounts receivable. What is the value? 56? 5660. And then you minus provision, the closing balance of provision. Provision means out of the total debtors, debtors are those customers you sell to on credit. You estimate that 200 will not pay their accounts, will not settle their accounts. So you are standing in for them. So you reduce from that account. So you only remain with those debtors that you expect to pay. So how much will that be? 5460. That is account receivable. Then we have prepaid what? Prepaid insurance. What is the value of prepaid insurance? 40. And then we have cash, isn't it? Cash. How much is the cash? Yeah. We had the cash. Where is the cash? 230. Yes. Any other asset that we are forgetting? I think those are the only one, if I'm not wrong. Then you write your capital and liabilities. Capital and liabilities. So we start with the capital. You start with capital Maria. Maria had a capital of 12,000, you write here 12,000. And then Bakari had a capital of 5,000, you write here 5,000. Then here you write here current account. Maria, the current account. Remember, current account is just an extension of capital account, but this one record the changes that occur oftenly. So it's part of capital account. So that one is how much? 5401.5. Then Bakari is 1861. Then here we have current liabilities. Current liabilities. So we have trade payables. How much is it? Trade payables, how much is it? 6,000. Then we have bank overdraft. Bank overdraft. If the bank balance is on the credit side, it means it's an overdraft. It's not an asset, it's a liability. It is 1070. Then we have accrued what? Accrued salaries and wages. How much is it? 200. Then we have accrued what? Electricity, which is how much? 90. So can we see whether they agree? So that is the end of that question. Any question? So this is partnership without changes. How much you get? 31? 820.5. And this other one? The same. So you can write that one, those ones who have not written. Those ones who have written, those ones who have not written, write. Write it very neatly. This is a very serious topic. So now you write there changes in the partnership, changes in partnership. You write there changes in partnership. Changes in partnership. Changes in partnership. Changes in partnership. Then you write the following changes can occur in a partnership business. The following changes can occur in a partnership business. The following changes can occur in a partnership business. Number one, admission of a new partner. Admission of a new partner. Two, retirement. Retirement of a partner. And three, changes in profit and loss sharing ratio. Changes in profit and loss sharing ratios. Changes in profit and loss sharing ratios. Changes in profit and loss sharing ratios. So then you write here adjusting entries, adjusting entries, adjusting entries in changes in partnership, on changes in partnership, on changes in partnership. Adjusting entries in changes in partnership. So you write when changes in a partnership occur, when changes in a partnership occur, when changes in a partnership occur, the following adjustments are made. Number one, number A, the following adjustments are made. Number A is revaluation. Revaluation. Then you write there revaluation on upward revaluation of on upward revaluation of assets. On upward revaluation of assets, you debit the asset and you credit revaluation account. Number two, on downward revaluation of assets. On downward revaluation of assets, you debit revaluation and you credit asset account. Number three, with the balance in the revaluation account, with the balance in the revaluation account, with the balance in the revaluation account, Roman 1, if profit debit, if profit debit revaluation account and credits capital account. Two, if loss debit capital account and credit revaluation. So that is the first adjustment, credit revaluation. And B, goodwill. B, goodwill. goodwill, so goodwill, you've written there. So on recognition of goodwill, so here on recognition of goodwill, one here, on recognition of goodwill, recognition, on recognition of goodwill, on recognition of goodwill, you debit goodwill account and you credit capital account. So with the old profit and loss ratio, 2, if goodwill is to be written off, if goodwill is to be written off, if goodwill is to be written off, you debit capital account and you credit goodwill with the new profit and loss ratio. See, if an asset is taken over by if an asset is taken over by a partner, it's taken over by a partner, so you debit capital account and you credit asset account. And D, with the new capital, with the new capital introduced on admission. The new capital introduced on admission, you debit bank, stroke cash, and you credit capital account. So those are the so that is, those are the changes that can occur in a partnership business. So in our next class, we'll be looking at questions that those questions that has these 3 elements. But in the meantime, in that group that we have, it is section FA. I have shared a question there, both on there's a question on partnership there. So you can see that question. Let me share it again. So you do that, you attempt that question. So make sure you attempt before the next class. Okay? So this, you can use this time remaining and you can start that question. Okay? So for today, that is the end of our class. We can't proceed further than this because we don't have sufficient time. So you can attempt that question that I've given you there. It is on the other one that does not require changes on partnership. Okay? So that is the end. So next class is very important. We'll be looking at the changes in partnership. So don't miss.